Okay, so in this video clip, we're going to go through how you can automate bankruptcy prediction using financial accounting ratios. The motivation here really is coming from a paper that was published in the European Journal of Operation Research in 2016. So that's it's very strongly ranked journal. And then the contributors to the paper were from Taiwan, and they used the authors are here, and they used financial ratios. So they engaged in effective bankruptcy prediction. They say it's critical for financial institutions to make appropriate lending decisions. In general, the input or features such as financial ratios, prediction techniques such as statistical and machine learning techniques are the two most important factors affecting prediction performance. So depending on what type of model you might use, you might get different results, but you're trying to predict based on financial ratios, and they also have corporate governance indicators, but you're trying to predict based on financial ratios. Is a company going to be bankrupt in a given year? And that's a sort of 1-0 outcome, a binary type outcome. Now, to get the very nice aspect here, like it's a beautiful paper. A lot of the time, our issue revolves around we can't replicate because we don't have the data. Turns out the data is available in Kaggle, and I shared a link here. It's also available on UCI Machine Learning Repository. So if I click on the link, it'll bring me into Kaggle. And if you have an account, now you need your account to download and to run the compiler in Kaggle. So you can just, if you have a Google account, you can passport through to Kaggle with that Google account. But you can see here this data. And if we take a further look here, bankruptcy, and then you have all these financial ratio. In fact, 95 ratios plus the bankruptcy column against the same authors. And then the data here, if you go down, you can observe the data. And it's all there. And if you want to download the data, just come over here, download. Takes a second. It's 5 MB, I saw somewhere, and it's data CSV. So if I go over to my downloads and take a look in here, it's come in as a data CSV, right? Which a moment ago, before I started to record, I unzipped that and just said it's data 0609. We can take a look at the CSV file, and that'll give us a sense of the dimension. So bankruptcy is 1-0, 1 being bankrupt, 0 otherwise. Most of the time it's zeros because most of the time companies are not bankrupt. And then you can see a whole range of financial ratios as well. So let's close that down. That's just to get an overview of the data. Let's go back into Kaggle here for a moment. Now, one very nice aspect associated with Kaggle, when you get an interesting data set, typically there are contributors to the Kaggle portal who put up their own code artifact, Python or R, typically. And you sort of, like, there's 196 here or 168. So if you want to toggle through, you can. And, but an interesting way is go for the one with the most votes, because that's the one that may have received a lot, the most interest. And, you can select any of these. Let's just go with this one for a moment. And you can go in and take a look at the proposed Python notebook and get a sense of what other people did. What machine learning did they use? Logistic regression, metrics, support vector machines, and some of the outputs that are getting confusion matrices set up using Seaborn heat map and classification reports, accuracy levels. Okay, so they're fairly standard and very useful. And you could learn a lot actually just going through what's provided here. But if you wanted to get into the notebook and maybe manipulate the code, you could edit my copy here. So if we click on this button, it'll bring us into a compiler, and we can just play around with the code here. And if we have a Kaggle account, we could save it to our own Kaggle account and keep it for later. Right? Now the data is linked to the notebook, so if we put in here, just execute, the data should have read in without too much difficulty. And if we go df head 20, we get 20 rows. If I remove that, it would default back to 5. And we get the shape. So there's 6,019 rows, 96 columns. And is there any missing data? No. Is there any duplicated data? Rows that are exactly the same? No. What information is available? So bankruptcy is a 0-1, so it's an integer, otherwise a float. So they have decimal places. And we could do some, if we import in matplotlib and Seaborn, we could set up a graph. Well, first of all, we could do a count, the 6,599 zeros and 220. So for instance, if I just wanted to say, okay, what proportion of companies are bankrupt, you could take the ratio of the two, 6,599. And 3% of companies are bankrupt. And then we could do run Seaborn can plot and compare, relatively speaking, the number of zeros against ones, so that most of the time companies are not bankrupt, but a bit of the time they are, 3% of the time they are. Now, we could go further, but I propose leaving there. Now, if there's something about this code that you appreciated and wanted to build into your own notebook, or you wanted to keep a copy of this available, maybe in set it up in your own machine, or take the code artifact and introduce it to your own Google Colab and save in Google Drive, you could download the notebook. Right? And if we shut this down and then go across to what we downloaded, we would have got this bankruptcy prediction. That IPYNB was the name of the file that came down. So if I want to open that up in my own Google Colab, I go back. Now I'm signed in to my account here. So I go into Google Drive, Google Colab in the browser. Let's open up, come down to welcome to Collaboratory. And then if I want to upload a specific IPYNB file, go to upload and then choose the file. And then the one we were working on, we can open up and go in and take a look, right? Now we can save it to our own drive, right? So if I wanted to save this, I could say File, save a copy, just so that I keep in my Google Drive this bankruptcy. And I typically put the date, today's date, so 06.09.23, bankruptcy prediction. And I can neutralize these, just comment out these lines of code and run, right? Now, if I run that, shouldn't be a problem because I'm just importing NumPy and Pandas. So it takes a second to connect to the server, and everything we're processing here is going through the server. Okay, so then if I do this, it won't work because it doesn't know where to read this, right? So the default location for the data is in the content folder. So if I go to the file icon and click through and then find the content folder, you'll notice here that there's no data except the sample data. So we downloaded the data from Kaggle, and I said I unzipped it before the video clip, and I can take this one here and upload, right? And then click OK. Now, if I try to read now, still a problem. In part because the data hasn't come up yet. Okay, so the data is there. If I read too quickly, so I should possibly wait a second to let this fully load up. Remember, there is 6,000 or so rows, and there's 96 columns. So even if I do read this in, I mightn't get the full data set. Wait till it completely loads. That's something you should pay attention to. And we'll remove the directory address here and just get data. And that corresponds to this. And I can do one of two things. Change the name here to reflect what's here, or rename this one and to be consistent with this. So maybe I'll just say 06.0923. So this file here gets read, and we create an object, a data frame called df. And then if I run df and say, okay, 10 columns, it'll run. And then all the other things that I've been doing should execute. Okay, so that works nicely, and that's a way you can piggyback on the work available and the artifacts available in Kaggle, because Kaggle has tons of data sets and contributors who have introduced code artifacts. Kaggle is a really wonderful, resource available, and it syncs very nicely with Google Colab as well. Okay, now I'm going to close down these collabs, and I'm going to revert back to the first collab we had because I have more detail in there, right? So this is the work I've been using, and it's the one we started off with. And there's a little bit more information. And then if you're new to Colab and you want maybe an overview, there's a video clip. So just click on the video clip, it'll play in the notebook. And then I've given them more. And in fact, what I did, I went to ChatGPT, loaded in all the ratios, and asked ChatGPT, would you come back and organize all the ratios we had into their appropriate categorization. So you'll see here X1, X2, X3, they're sequential, right? But then we have X20 and X16. So this would have been the 20th ratio. Kaggle figured out ChatGPT, when I loaded in all the ratio labels into ChatGPT and said organize and bring back definitions, it just set up the definitions here. So these, if you're not familiar with the financial ratios and you would like a definition, this is a kind of a quick reckoner that you can go back and refer to. Now, the problem is more sometimes is less, but at least here we have a set of definitions that go along with the labels, and I've left those there in that text cell. Okay, so as an accountant or a financial analyst, if we were trying to understand our data set, the first go-to generally is Pandas. And again, I've left a video clip here where you can go back and review a little bit an introduction to Pandas and some of the syntax and the grammar. And then I've also something similar with a cheat sheet applied to the Parma Penguins dataset could be useful. But if you're a little bit more happy with that data, a Pandas skip through. Now, here I already uploaded, right? So this accounting credit risk wasn't here before. So if I delete that file and then run here, import, try to read the data, and call that data object data instead of df, it won't work. So I need to go to the content folder and bring in, upload the file with the correct name. Now the file is actually the file I had from yesterday. It's this one. So I'll just open that up. But again, I took it from Kaggle, right? And just relabeled it accounting credit risk. Now it takes a minute. If I read the file, it's very important that you wait till the file completely loads up. If I read, it actually will lift off what's available, but you may not get the full 6,000 rows of data. So because the data here is 5 MB, it takes a minute to upload depending on the speed of your broadband connection and also availability of space on the Google Drive, on the Google server, right? So again, we're not quite ready yet to read in the data. Now we should be, so let's read that data. And okay, and what's in the data? It's before we had said it's df, now it's data. Okay, so there's, same. What are the name of the columns? What information? Bankruptcy is an integer, all the rest are floats. Would appear. Number of records, number of zeros, 6,241, 96. And is there any missing data? No. Oh, there is. Okay, so we haven't fully loaded up our data. If there's print data, let's just see. Okay, so just to be sure, I'll go back and just run this again, because there should be no missing data. But because it's quite a big file, we might find that there's a little bit of latency, and when you load up, so there's 6,819 rows, that sounds right. And so you see we had 6,241, that should go up to 6,800. And now the data's been fully read in. So there's a little bit of latency. You've got to wait a minute for all the data to load up and then proceed. So the numbers will change around a little bit again. 6,819 records, right? And number of features. So it's like rows and columns. And is there missing data? No. Right, so what we're looking for here, is there missing data? False. So there's no missing data, right? Descriptive statistics, and then load that in. So we create this object called descriptive statistics, and we load it in, and we could transpose that. So instead of getting, it's hard to read this, so it might be easier to read it the other way around and look at the mean, standard deviation, minimum, and maximum. And that goes all the way, well, do we get, I think, yeah, 96, I would say. Right, so by transposing it, you switch around the columns for the rows. So you tilt it over, and we're getting that by using T, and then head is 40. I don't think I can exceed 50. If I go to 50, I think I get that, but it won't go 90. So I don't actually have all the rows popping up here. Okay, but it's there, all the data is in there, it's just visualizing it. Now we want to visualize a little bit our data, and we can see overwhelmingly companies are not bankrupt, but there's a small minority that are bankrupt. And if we estimate that as a percentage, it's about 3%, a little bit over. And we could do, now this is a very nice feature associated with Matplotlib. I leave a link to a video clip that explains Matplotlib, but it takes a little while for it to load up because, again, the data set is not small. It's actually quite a significant amount of data. It's not big data in terms of it's just 5 MB, but it's that 6,800 rows with the 96 columns involves a bit of processing power to generate graphs. But we do get reasonably nice graphs, and we can see here a 0 or a 1. So 0 meaning company not bankrupt, and if it's a 1, the company's bankrupt. Also, if we look at this data, we can see, and I probably should have pointed this out before, the lowest value is 0, the highest value is 1 for each of those ratios. So you can actually go in and zoom in on what's in the data, and it's quite, the resolution's quite decent. Again, you might say more is less. I found this sort of useful to get a sense of what the magnitudes of the data were, but it is limited. Again, this shouldn't be strictly, if we go back to the, maximum and minimum, the minimum value is for all of them is 0, and the maximum value for all of them is 1, or a little bit away. So there's an exception here and there, but that looks a bit funny, right? So there must have been some kind of min-max scaling applied to the data already, right? So we're not quite getting your standard ratios. It's ratios that have been min-maxed scaled, which is something you can do in the sklearn library, which we'll refer to in a moment. Okay, so the visualization here, the histogram plot actually of each column brings that very much out, right? That we're minimum of 0, maximum of 1 for all of them. And if we generate the correlation matrix here, because we have 96 rows, it's going to be a 96 by 96 matrix. It's going to take a little bit of time to estimate each individual correlation and the cross correlations, and then provide a heat map. Again, this is we're using both Seaborn and Matplotlib here. So the correlation matrix is, okay, generate the correlation matrix from the data. That's the data object we've been working with. And we'll refer to this correlation matrix. And then we're saying, look, we want to do a heat map. So this in the Seaborn library, set up your heat map of this correlation matrix, annotate true, and then cool warm, but we might have other labels that we're capable of putting in, go to 2 decimal places, and then specifications for line width. So we can parameterize a graph here to reflect what we need. Problem with this, it's just the scale, it's beyond maybe synthesizing into something that is reasonable, that we can understand, but just to get, what's, bankrupt, all the ratios on the vertical and on the horizontal are set up, and then the correlation between each individual. So on the diagonal, it's always 1, because this is ROAC correlated with ROAC is 1. So on the diagonal, it's 1. For the profit ratios, a few of these look like they're all profit. They're all highly correlated with a peer, especially these ones. And you can get a sense of high degree of correlation. Maximum correlation is 1, minimum is -1, and if there's no correlation, 0. So the in between is that gray area. There's lots of so it's too big, difficult to conceptualize. Maybe there's a way we could, in a very kind of low-tech way, say, could we just go with those variables? Could we select out from the 96 or 95 financial ratios, pick out those ratios that have a correlation in excess of 0.1 with bankruptcy and print them out? And when we do that, we can see, okay, the profits seem to be highly negatively correlated. So the higher the profit, the less likely you are to be to go into bankruptcy. But then the earnings per share is also kind of a profit measure per share, net profit, something similar. Debt ratio. The more indebted you are, the more likely it is you're going to run into problems. I suppose if you've no debt, it's hard to go bankrupt. But if you have a lot of debt, you're likely to go bankrupt. So positive correlation exceeding 0.2, and the other figures look like profit figures. So this is kind of a low-tech way of trying to make sense out of this, right? So if you have a lot of data and you're trying to kind of parse through and come up with visualizations that are intuitive, you know, this is a problem of dimensionality, and a low-tech way of reducing the dimensions here, just go take a very crude measure like correlation and see which of the variables has the strongest association or disassociation with the target variable, which is bankruptcy. Okay, so if you want to get some more primers on visualization, you can follow the link. And I set up pretty much what's available on the Google Colab charts as well, for 3D type subplotting. Okay, so in our case, we want to just map out. So we fine-tuned, again, in a very crude way with a very arbitrary threshold here for the correlation of 0.2. We're saying estimate the correlation matrix again, create an object called correlation matrix. We've done that before. Then select the variables that correlate with bankruptcy where they exceed this threshold of 0.2. So where the correlation between bankruptcy and the relevant variable exceeds 0.2, we'll keep that and keep it as a selected variable. So we're using here kind of a selection of pandas and statistical operations and NumPy to create a selected series of variables, and then from there we go back and reproduce our heat map. Now previously our heat map looked like this for the entire set of financial ratios, and to deal with the dimensionality problem we filter out just by going with those ratios with the highest correlation with bankruptcy. And we sort of get a more manageable type image, but maybe not hugely informative, and maybe we've lost a lot here as well, in the sense that we've mainly picked out profitability, and then we have the debt ratio and net worth divided by assets, and that seems to have a perfect -1, which seems to suggest that this is the inverse of the other, right? If with that -1 and 1. So but at least we have something that might indicate in a very sort of intuitive fashion what might be driving bankruptcy. And it might be useful to visualize. So we might just pick out, if we take the first one here, or this one here, ROAA, so return on assets before interest and percentage after tax, and create a scatter plot using Seaborn, where on the y-axis we have the return on assets, and then This is for the 6,800. So each dot here represents a row. And we've mapped out those companies that are not bankrupt. And the orange color here is where the company's bankrupt. And we can see a pattern emerging that where the profitability is less, it does seem to have a stronger association with bankruptcy. So if we go zoom in a little bit, we're saying where we have a 1 indicating bankruptcy, that seems to be associated with lower levels of profitability. Okay, so we might be onto something here. Again, same but ROAB, so before interest and depreciation after tax. Run the same scatter plot from Seaborn. A similar pattern emerges. Again, story here is profitability. If you're a highly profitable company, perhaps the chances of being bankrupt are greatly reduced. But if your profitability is low, chances increase. So it's not a, we do have exceptions there, right, where there is low profitability and the company is not bankrupt or doesn't go bankrupt. But many of the companies that are bankrupt end up in bankruptcy have these lower profits. Their profitability is less. And again, the same here, net income to total assets, a similar picture. But when we look at the debt ratio and compare it to bankruptcy, it's pivots around the other way. So those companies that are most indebted seem to have a higher association with bankruptcy, but there is also exceptions here as well. So it's not a hard and fast rule we've created here, but just we can discern patterns just visually. And that can be very powerful because sometimes the models we create are not that easy to interrogate, but the visual representations do provide us with a certain amount of clarity. Now we could set up a Pandas data frame and we refer to these series of variables as financial data. And we could look at the first 10 rows. We could change that to 20, run the same command again, and we get 20 rows of data, perform some descriptive statistics. Now remember, it's still the 6,819 and each related to each of those selected variables. And we could do another form of interesting visualization, our bar plots for Seaborn, and we could compare those companies that are not bankrupt against those companies that are bankrupt and compare the mean level of the accounting magnitude. Remember, they're bounded by 0 and 1, where the companies, for the return on assets before interest and depreciation, those companies that have the higher profitability have a higher mean. So the blue here means they weren't bankrupt, they have a higher average profitability. And we see that across the board. On average, the profitability, those companies that are not bankrupt have higher levels of profitability. But then if the company is more indebted, we associate that with higher. So the mean indebtedness of companies that go bankrupt tends to be on average higher than the ones who don't, which also makes sense. So again, intuitively, something going on there that seems to correspond with any standard type of analysis. Very low tech, but also provides a very compelling picture. Now, typically, if we're trying to go to the next step, we set up a model that somehow systematizes all the financial ratios and links back to bankruptcy. One, in the classification area, one model that's very common is logistic regression. I've put a series of 3 videos here. I think these would be quite useful to see how logistic regression is set up in Excel using VBA and comparing the logistic model against ordinary least squares modeling. Again, if you're totally unfamiliar with OLS and logistic regression, these would be useful primers before you step into logistic regression. So once you perhaps have reviewed these video clips, right, and get a sense of what it means that we create a model, we parameterize a model, we minimize the error, that the OLS model is linear while logistic regression is nonlinear, while logistic regression is a maximum likelihood estimation. If you familiarize yourself with these primer videos, then that would facilitate or give you a better sense of what's happening in the rest of the Colab here. The rest is actually quite abstract, but this is typically the construction. If you're doing machine learning and you're trying to do a classification type of exercise, you use logistic regression. I'll just call the data bank, so create a new object, which is just a copy of the data, and it's now called bank. And then I'm going to invoke the sklearn library, which is probably the most well-known, the most used, or in the last 8-9 years, a very heavily used library for machine learning. And we separate in our data the X from the Y. So the X's are the independent variables, basically the financial ratios, and the Y's here, the Y, only one Y, is the bankruptcy. It's the 1-0 column. So bankruptcy is either 1-0. So we're trying to predict the 0-1 outcome by all the other financial ratios. And we're using the iloc referencing available in Python to bifurcate the independent variables from the dependent variables. We also, using sklearn, do a test train split. So we train the model on the default would be we take 75% of all the observations in the model, and we randomly pull out the 75% of the rows, and we estimate the model. And then we go back and we look at how the model predicts relative to the training data set, and then the holdout data set, which is the test data. So basically, in this code cell here, 2 actions are performed. We split the X's from the Y variable, and then we subdivide the data into the training data, which is used to parameterize the model. And then the test data is the holdout data that we use for robustness. And we'll compare the accuracy of the model for the training data, and then we'll see, does it stand up? Is it robust when we use the holdout data? If we have an X train, we must have a Y train. If we have an X testing data, we have a Y testing. If we don't make any other explicit reference here, it subdivides into 25% testing, 75% training. And again, I've left a little bit of commentary here explaining how the terminology a little bit, so you can familiarize yourself with that. And remember the Y here, if we were just to map out the Y, the target variable, we can see the bulk of the time companies are not bankrupt. So in very few instances, but in a few out of the 6,800 or so rows, only 220 of the entire number was a situation where there was bankruptcy. So, most of the time, if you just predict not bankrupt, you're going to be right the bulk of the time. So if you want to look for more complete overview of models like random forest and k-nearest neighbor and support vector machines, I have a previous video clip for red wine, which is a smaller data set and might be useful if you want to sort of look a little bit more comprehensively at machine learning techniques. But in this video clip, I'm going to stick rigidly with logistic regression. So I'm going to perform now. I have to make sure I've performed that test train split. And then I can proceed to running the logistic regression model. And again, in a Colab, this is at a very high level, and a lot of things are taking place, like fitting the model and getting accuracy measures all occurs by putting in a few lines of code to see how that actually works and how that operates closer to the data. I strongly recommend go into these video clips to see how in an Excel type setup we actually estimate and parameterize models and then estimate the model fit and then compare accuracy levels for the models. Okay. But the end product is generally an overall accuracy for the training data and the testing data. And when we run our model, we find for the 75% of the data in the training data, when we parameterize the model and produce the fit, the accuracy of the model is 96%. And for the holdout data, when we predict bankruptcy using the financial ratios as inputs into the model, we're still getting 96, so not fairly robust set of results. To understand maybe how we read the confusion matrix, the confusion matrix is set up in a way that it's basically comparing the fit against the true. So the model prediction, the predicted model results, the fit against the true. And then, for instance, here, this 4 represents in the training data, we predicted that there was 4 bankruptcies we predicted, and they were actually true. And there's 4,938 companies we predicted weren't bankrupt, and that was true. But then the error here resides in the false positives and the false negatives. So there's 14 false positives, 158 false negatives. Overall accuracy 96.6. For the holdout data or the test data, we didn't predict any correctly, any of those that were bankrupt. Now, there was bankruptcies in that data, but we didn't get any of those correct. So there was false positives and there was false negatives. So these 58 were actually bankruptcies, but we didn't predict any of them with the model in the testing data, which sort of suggests our models this logistic model would have to be souped up, or maybe we should try to consider other types of model, or maybe more importantly, maybe we could tweak a little bit the classification threshold, because typically from the logistic model, we get a fit bounded between 0 and 1. And if the fit from the model is in excess of 0.5, we'd say that's true, that it is a positive, but if it's less, it's a negative. And if we tweak the classification threshold, we might be able to get more of these 58s coming over here. But then we might swell up the number here also as well. So we could predispose to predict. Now, again, for certain areas, if this was a medical diagnosis, we might be prepared to accept a lot of false positives, so long as we were able to flag more true positives, because that would be important that we get to the patient and we could tell them earlier, look, this is the situation and you've got to act promptly. So in a medical type situation, now there's a little bit of an overview about that, and I'm going to leave, I left the link here. And this is from machine learning. It's a Google crash course. And you might take a look at this ROC curve and how if you tweak the classification threshold, you can actually produce more true positives, but there is a cost associated and you might get a deterioration overall in accuracy. So sometimes you've got to consider, is it a flagging system? Is it a piece of radar you've created? Is it a crystal ball that is trying to map out high risk situations? Or if there's a low cost associated with a particular type of classification, you might be more attuned to just increasing the level of accuracy. It depends on what the model is set up to do and what are the costs of, the false positives against the false negatives. You might be prepared to take a lot more false positives if you could swell up the true positives in your predictions. So tweaking the classification threshold could be important in that regard. Now, given that this model, I mean, its overall accuracy is 96%, and you say that's great, but if you took a naive strategy that just said everybody's going to be fine, no bankruptcy, you'd also have a similar level of accuracy. We said before when we performed that analysis, taking the ratio of bankrupt relative to overall, it was just 3%. So in fact, if you said I'm going to predict everybody's going to be fine, no bankruptcy, then if I said 1 minus or 0.03, we would be getting 96% accuracy anyway. So our model is not beating a naive estimator. Now, that doesn't mean there's no value in the model, because this model could be tweaked in a way that it becomes a way of filtering out the high risk categories. So you may not have a perfect crystal ball, but you may have a radar that you can switch on based on this logistic regression model that will weed out a lot of get more true positives, but also probably overpredict getting false positives as well. You can swell up the true positives if you're prepared to accept more false positives. And sometimes that tweaking that is perfectly legitimate to do. If you want to see now, given that this logistic regression model is not beating the naive model, you could take a look at there's a notebook here from Kaggle. So somebody else has used the data set that we were working with. I'll show you the link here, but also has produced a YouTube. So I'm going to send a little bit of business his way. And if we take a look at his Kaggle, the code artifact is put up on the Kaggle portal, and it gives an overall assessment of the level of accuracy for a variety of different models. So he looks at logistic regression, k-nearest neighbor, decision tree, support vector machines, neural network, random forest gradient. So they're all standard techniques, but we're still in the region of 96%. He also performs principal components, which is a way of reducing the dimensions of the data set, and that would speed up estimation to some degree. And it doesn't really materially reduce the level of accuracy. He finds it all very marginal, but he does it for completeness, and it's a very nice Kaggle to take a look at. About half an hour of video, I think. And then a little bit more here in terms of terms that we're using. If you're not familiar, you might go back and take a look here. And Wikipedia also has a good source on confusion matrices. Okay, so not quite a crystal ball, but perhaps a device to weed out, or if you like, a primitive type of radar can be mounted with these machine learning models. But a key benchmark in terms of overall accuracy, does the model outperform a naive model? No, right? And so what that requires then is a little bit of tweaking around classification threshold, and you may be able to capture a few more true positives, but you're going to also pull in the net more false positives, and that's typically, you might be prepared to accept that. So if the cost of bankruptcy was extremely high, a bank might be prepared to sacrifice not lending to maybe a number of companies that have very low profits and a lot of indebtedness, and weed those ones out and stick with the companies that the logistic regression model is predicting much safer. Stick with the safer companies. So again, it depends on what the model is being crafted to do and what are the costs of not correctly predicting. If this true positive, if predicting, finding even the few companies that are problematic, if you can weed out those companies most likely to end up in bankruptcy, if you can avoid that cost, then you might be prepared to sacrifice inaccurately predicting a few companies that are normally quite healthy or end up being okay, no bankruptcy, but they get lumped in with the true positives. So if the logistic regression here could be tweaked that you remove a lot of those, you can pick up on the true positives, but you're going to lose a little bit of business because some people who turn up you won't lend to because the model is saying likely to be bankrupt based on their financial ratios. Also, it's worth noting in the original paper, they combine the financial ratios with corporate governance indicators. Now, we don't have access to this data, so we can't tweak the model by improving accuracy by introducing those indicators. Nevertheless, this is quite a nice data set, and it allows us to practice a little bit on using financial ratios and seeing sometimes the limitations also associated with these models. Okay, let's leave it there.